What's up, guys? This is Shane Scofield of Scofield Trading, and me and Ty are here to bring you another weekly update of the markets. Today's date is the 27th of May 2017. Quickly show you guys this disclaimer, pause it and have a quick read through it. Remember to always keep your risks limited. A bit about myself. I'm Shane Scofield. I'm the founder of Scofield Trading. I trade US equities and I'm a technical trend trader. I'm a public speaker. I help retail traders learn how to trade the market the smart way. I also manage a private fund under Scofield Trading, and I started off spread betting from home like most people will be doing, and I managed to turn a 4-figure account into 6 figures in the space of 18 months from little and no experience, no college or university degrees or anything. Also, there's a free ebook available on our website, and it literally tells you the story of exactly how I did it and also shows audited accounts.
Hi guys, my name is Ty Vinnick. I am one of the founding partners of the Ace of Swords fund out in California. So I specialize in trading options on futures and market indices, different commodities, options on futures, options on S&P and things like that. I have experience with professional type of strategies such as option spreads and things of that sort. I'm a market timer. I'm a technical and statistical trader.
Okay guys, so here's a quick update on the Dow Jones Industrial Average. As we can see, the markets have been really strong for the following week, pushing up close to new highs on the Dow Jones. In my opinion, I think that the market actually looks very, very strong, and the reason I believe that is because there's other sectors that are doing extremely well. Another sector like XLK, which is the technology sector, which is still breaking out and looking very strong. We've also got XLP, which is the consumer staples sector, which is also breaking out and is very strong. And I think that these are signs that the market overall is very, very strong. You've also got companies like Walmart, which is also trending upwards and had really good earnings and is still looking very strong. Just in my opinion, I think that's a sign that the economy is doing extremely well. And also companies like Best Buy, which is also performing extremely well and breaking out. And I just think that companies like this is just a signal that the overall economy is just doing extremely well. Now, the best way that I would say to trade this is to stick with long stocks, good strong stocks, and I think that overall correction could happen at some point at any time, but I don't think it's going to happen yet. The reason I believe that is because looking at the VIX, you can see that when volume is low, it can stay low for a very, very long time. So as you can see recently, as Ty said, when this gap needed to be filled, that's now been filled and it's now come back down again. And I think that the volume could potentially stay low for a little while before it has its spike again, which will then trigger the 10% correction. And I think the way to trade this is to wait out what's happening at the moment. When the 10% correction does happen, then that could potentially be a great buying opportunity. So I think it's best to just wait out. If you want to try and catch the correction, then the best way to do that would be to do options. Or if not, and have like medium to long-term contracts, like 3 to 4 months that last at least until September. Or if not, then I think the best way is to just short week stocks. So you can have stocks like Ralph Lauren, which is trending downwards and breaking down to the downside. I think that this could potentially go further. And another company that's also looking weak and trending to the downside is Harley Davidson, which is also breaking down and looking extremely weak. So I think that instead of shorting the overall market, it might be safer to short individual stocks with low risk. I think that would be much better. And then possibly wait for this 10% correction to happen and then take the markets to the upside afterwards. Looking at the Dow Jones, I think that it's actually looking very, very strong. So first of all, if we just have a look at the sentiment, as you can see on IG index, you can see that 83% of people were short. So a lot of people were short at the moment, and for me that's a signal that the market could potentially go on to make new highs and break out and keep trending upwards. Also, if we look at the monthly chart on the Dow Jones Industrial Average, we can see that we currently have a hammer bar at the top. And for me, this is a signal that the sell-offs are being bought extremely quickly, and we could potentially be breaking out to the upside. Also, if we have a look on the weekly chart, if we just take a small trend line from here, you can see hammer bars forming off of this trend line and then eventually pushing up to the upside. I think overall that this is quite bullish at the moment, and seasonality for the end of May tends to be strong, especially after Memorial Weekend, which is happening right now. And I think that this could potentially break up to the upside and potentially make more highs. So that's just my overall review on the markets at the moment. I think it's actually looking very strong, and I think that a lot of people are predicting this correction. And I think it will happen, but it's not going to happen yet. I think probably in around July, August, and September, there'll be a big correction with then a fantastic buying opportunity to take the markets possibly up to new highs for the end of the year.
Pretty good. I have to disagree with you this time around. Not that necessarily I think that the breakout here into new highs is not bullish, but something tells me there's still work that needs to be done. We saw that large down day on Wednesday, and yes, it got bought very quickly. However, it did so on pretty weak volume, and the VIX has just gone back to those single-digit levels very, very quickly. And although the volatility can stay low for a long time, it's unlikely to stay below 10 for a long time. If you can see in that chart, it can stay in the 12 to 13 area for quite some time, but when it gets to single digits, it just never stays there for more than a few days. So let's look here at the Russell 2000, the IWM. I've taken options trades in this last week, and so far it's been doing okay. And what's interesting is that I have a pretty bearish portfolio at the moment, and I had a up week on the P&L, so that shouldn't happen when the market breaks to new highs. Something tells me that underneath the surface, things are still not as healthy as they appear to be. You can see that the Russell 2000 is far from making a new high, and even though some sectors are breaking to new highs like technology, the broad market is not. And in fact, it's still in this downtrend line. So we actually have a huge disagreement between different market indices. And you can even see we had a shooting star bar and then a move lower. So it's a huge discrepancy between different types of market. I can look here at a comparison to the Dow. And you can see that here's the Dow higher, and the Russell is not confirming that. Here, when we had the breakout after the election, the Russell was far stronger than the Dow, suggesting the Dow will go higher, and that's what happened. And now we're actually seeing a bearish type of divergence taking place. I'm seeing a lot of divergences taking place in multiple sectors. Let's actually look at the Dow. And this will be a little bit of a lesson in intermarket analysis types, more of the macro type of ideas. So when the economy is heating up, as Shane suggested, you will see higher bond yields, meaning there's more demand for money to go around. If there's more demand for money, interest rates tend to rise. We can look at TNX, that's the 10-year Treasury, and you can see how that correlates with the Dow pretty well. Here is this melt up in yields and stocks after the election. But look what's happening here. Yields are starting to drop back lower, signaling a cooling economy, while the Dow is still moving to new highs. Let's compare this to the US dollar, and we can see the same thing. US dollar yields are correlated. US dollar is really breaking down, signaling something else is going on. I'm still seeing this as a potential bull trap, and if we cannot exceed these highs by any means or make it just a marginal high and roll over, I think that the Dow may actually catch down to these somewhere between the dollar and the yield level. So, you know, we could be looking at a move to the 20,000 level pretty easily. So this will probably be a breakout that I'm not going to buy, and I'm still going to stay short. So if we look at gold, for example, we talked about this a couple of weeks ago. This has been a great trade. Entering around here, it's done nothing but going up. In a situation where the economy is doing so good and consumers are buying more, gold shouldn't be performing much better than the Dow for the year. let's see, January 2017 started around here. Gold's up 12% for the year. Why? I think it's telling us something, that things are not as good as they're supposed to be. We're having a breakout as well in the TLT. It's very strong. So the TLT is the long bond. So when we had the yields falling, essentially we have bonds going up. This is looking very bullish to me at the same time as when stocks are breaking to new highs. These are all things that are not really supposed to happen. At the same time, we spoke about the bank index, and XLF is giving us a very ominous type of look, head and shoulders. Again, we can compare this to the Dow and see how we are having a big non-confirmation signal. Banks are leading the way for the Dow, and all of a sudden the Dow's breaking out, but banks are nowhere near making a new high, and they actually look to be rolling over. So the trade of short banks and long bonds is still valid, and in this type of condition in the markets, I have to wonder whether or not this breakout in the Dow is going to fail or not. I believe that it still could. Going back here to the VIX, so going back here into the VIX, we can draw that trend line again, but we can also draw a lower boundary. And we can see that the VIX doesn't stay that long in the, yes, it can stay long in this type of range, but once it gets into single digits, it's a high risk entry point. Again, I like to compare things. So if I compare this to the Dow, okay, so what do we have here in this comparison to the Dow? When we have these very low levels at the VIX, again here, well, this one didn't really quite work out, didn't it? But nothing is perfect. Around here, once we get to these very low levels, yes, it's true it can stay low for a while, but we're entering a very high risk period. You can even go even further back and see that, okay, low VIX usually coincide with some kind of top. It's much better to enter the market on one of these spikes. So when we're at these low levels, and right now I'm seeing these macro factors like the bonds and the banks and the small caps not confirming this breakout to new highs, I would not be buying it. So what I would be looking to do is stay in option positions that will give me a big benefit to the downside in the market in case there's a correction. Especially since the VIX is so low, that means that the purchase price of options is relatively cheap. I would be looking for one more spike. As you can see, we're having a more and more tightening wedge in the VIX index. The next one may actually go through this line here. So I think the risks into the summer and fall are starting to get very severe, and we could potentially be looking at the 10% correction sooner rather than later. So my opinion is, if you're in the market long term, stay in. If you're looking to start a position, I wouldn't be buying it at the moment.
So guys, if you want to sign up to our YouTube video, where we're giving out free contents every week with market reviews, I'm also going to be giving out a lot more stuff. Just subscribe to our channel. Also, if you want to get in touch with us, get in touch with us at contact@scofieldtrading.com. That's the website and also the phone number. Also, we're coming up with our options course that me and Ty are forming at the moment, which should be released very, very, very soon. So if you're interested in learning to trade the smart and professional way and take your trading knowledge to a whole new level, then this course is definitely going to be the one for you.
Right. So this gives you a lot of information of how to create these option strategies that we're talking about. It says our views on the market can conflict. We don't know exactly what to do, but these options allow us to be right when we're wrong, cover a range, and really trade the market in ways that you cannot do unless you have the ability to trade options and cover wide ranges and being right on both directions. A lot of times I find that I'm not 100% right on the market, and that's normal. That happens to all of us. Mm-hmm. But if you can be right 60% of the time and be able to utilize when you're right and when you're wrong as well with the right strategy, then that makes the world of difference.
And also with the low risk as well. So
yeah, absolutely. This allows you to control your risk far better than a traditional stop loss, as an example.
Because as long as you have limited risk, you can be wrong more times than you're right and still make a lot of money.
Right, right. But, you know, if you combine the tools and the technical knowledge with it, then you really can enjoy both worlds and sleep better at night.
Yeah, that's definitely. So with the course, you're going to be able to learn the basics of options trading. Also, you're going to learn the secrets of 8-figure hedge funds. So, you know, it's really, really big strategies that we're going to be giving out to everyone. And, of course, you make money in all market conditions, whether the market goes up or sideways, and you can make even more money when the markets go down, which is hard for clients to believe, but it's actually true. And
I make the most amount of money in down markets. It's my favorite, personally.
yeah, and also just limit your trading risks. So you know you have limited risk for potentially very high reward. So it just makes sense. All right, guys, we'll be back next week.
Sounds good.